Good afternoon, ladies and gentlemen. Welcome to this webinar today about basics of price action. This is the third week of January, the last week of January. We're looking at the basics of price action. Remember, we started with the simple tools that you can use, and then we went on to the risk management or ways of controlling risk. And now we're here, I want to look at the basics of price action. Thank you so much for taking your time to attend. Just want to give like 1 more minute because I see attendees are still streaming in so that we can kick it off. On your control panel, remember you have a space where you can type your questions. Feel free to ask any questions that you have, and we will make sure we look at the questions towards the end of this presentation. This webinar will be going on from, is designed to go on from 2 p.m. to 3. So we have 1 hour. All right, ladies and gentlemen, here we start off. My name is Matthew. I'm taking you through this training all the way from Nakuru. Feel free to ask any questions. Now, we want to speak about the basics of price action. What is price action? This is basically the study of the movement of the prices of a financial instrument. And traders use price action as a way of identifying entries into the market. The basis of price action actually gives you the ability to identify the likely points of strong support and resistance, and of course, get the ability to interpret the Japanese candlestick and all those patterns. That's where you get the entries. That's why you're able to identify the entries and exit into the market. Trading must be smart, right? It doesn't have to be a thing of over complications, all right? So less sometimes can be more. Price action trading keeps your forex charts as simple as it can be for you to be successful. Now, price action trading is just using the technical analysis or movement of the price itself rather than the use of technical indicators. In price action trading, we're going to focus more on the Japanese candlesticks, and then of course the support and resistance levels, and that's really very important to help you have an edge in the markets. So when we're trading using the price action, here you're not including the indicators like the MACD, Bollinger Band, stochastics, you can name them. So price action is a good method for new traders, of course, because new traders often make common mistakes when you are using the other indicators and then you overload them. So it becomes, there's that challenge of having so many indicators on the market and you're not able to interpret them. So price action becomes a little bit easy for new traders. So too many indicators on the chart again makes the chart very crowded and becomes a little bit difficult to make a decision. That's why I would recommend, if you can understand the price action fast, it can work out for you, especially if you are starting. Just like the analogy of a car, when you're starting out, remember you get the simple instructions first to follow by the instructor, all right? And then with time, of course, you get along capturing the things that you require to be that professional driver. Even with forex trading, it's just the same way. You just have to know where to start from. With time, of course, you're going to know how to use the technical indicators if you're starting up, but basics first, all right? Price action is the basis of technical analysis, all right? And you need to grasp it well for you to be really successful in your trade. Remember, even when you're using the technical indicators, you have to you go back to the price action to make a decision on whether you want to enter the market going long or going short. Now, why does trading the price action work actually? Price action analysis of a chart gives you the predictive power in forecasting the future movements in the price, and it's because price action reveals the movement of the market with respect to the buyers and sellers in the market, right? These players, they try to hide sometimes, but it's very difficult to see their big moves, all right? So your job as a trader is you want to find the way in which they are taking, so that you can, of course, jump in and ride a trend. So how do you trade price action? You need to draw significant support and resistance levels, of course, to get the long-term trend lines. Of course, you not putting anything else on the screen, you have got clean charts, all right? And your work is just to study the movement of those prices. Of course, you're drawing lines, the support and resistance. Now, how the candlesticks are formed is what you are really keen on, because every candlestick tells a story. And based on the observations, of course, you're going to ask yourself several questions. Yeah, some of these things that you need to ask yourself is, are you seeing that the candlesticks are closing up or down, right? Did it close near the top or bottom or near the middle? Is the candlestick engulfing the previous candlestick that have been formed? Yeah. Is it significantly larger or smaller than the recent candles if it has been formed as an engulfing candlestick? Did it form a long wick bouncing off any kind of support or resistance or even a trend line? So again, you want to know, is it the first candle that closed outside a certain range? Maybe with a trend line or support resistance, all right? So these are the questions that you have to ask yourself when you're looking at how these candlesticks are being formed, because the structure of a candlestick actually gives you the information about how buyers and sellers are doing in the market. Now, here are important candlesticks for you to consider. Basically, a candlestick is a single or a multiple price pattern, of course, shown graphically, and it just helps you to predict the market movements. There are various types of candlesticks patterns available. I just want to focus on a few that have been studied over time and proven to have an effective meaning and can help a trader in making decisions. Number one, let's look at the Pinbar candlestick patterns. A Pinbar is a pattern that shows rejection of price on a certain level or area. Of course, it has the characteristic of a Pinbar is a small body, right, and a very long shadow or wick on one side. So where you're seeing a very long shadow or wick, it just shows the rejection of the price. So you can trade the pin bars as reversals of a given trend. For example, you've been on a downtrend and then you see a pin bar below that trend, then of course you get the idea that the price is being rejected on the other side of the trend. It might be the time that the trend is just about to change. So it gives you a strong early signal of a possibility of a trend reversal. And the best points that you'll be looking at is along support or resistance levels. And you can make a decision. For example, when you look there on the chart, you can see we have these pin bars that have got a very long wick on the lower side, right? One of them doesn't have even a body at all, okay? And that one shows the rejection of the price from downside. Okay, on the right side of your screen, you can see that we have the long wicks at the top. That one shows the rejection of the price from the top, from the upside. And those are the classical examples of pin bars showing the rejection of price. When you see those type of candlesticks, what you get as a trader is the idea that now it might be about the time that the trend is changing. That's really very important. Looking at that chart here, just as an example, the long lower shadows, of course, indicate that there was intense selling activity initially. Remember, the price was there, right? And then the buyers came in and placed large buy volumes towards the close of the time frame. That's overturning the initial selling pressure. So when such candlesticks, of course, form along the support zones, like you can see on that support trend line, that's when it's an indication that there is an imminent market rally towards the upside, right? So whenever you see a very long wick, or whenever you see a wick, it's just an indication that price was there initially, right? But where you see the body now is indicating the range between the opening and closing. So for this candlestick that I've got very long wicks, and of course they're on the downside and they're carrying a long major support trend line, then it's an indication that we are likely to have the price keeping on that uptrend. It's a rejection of the price along that support trend line there. It's really something that you need to watch as a trader. So when you're drawing support and resistance on your charts, remember we say that you keep your charts clean if you a price action trader. Now your job is to keep checking on when the price approaches that support trend line, and you keeping watch of the type of candlesticks that are forming there. If you see those type of pin bars there, then you wait for a confirmation, of course, and you can be in or jump in for a ride of the uptrend. Again, when we come to a downtrend, right, you see there that we have the candlesticks, the pin bars, of course, that have got a very long shadow. It's a rejection of the price from the top side. If you check on the charts there, you can see that after a rejection of the price along that resistance trend line, then you get a confirmation and boom, you get a chance to jump in and ride the downtrend. All right. So what it means there is that there was intense buying at the beginning, and that's why you see the price was at the top there. Where you see that tip, it means that the price was at that point, and that was being driven by the buyers. But again, sellers came in with large volumes, selling big volumes there, and then it created that there was that rejection of the price, and then of course sellers came in with large volumes, and then you have the trend going down. So again, with the clean charts and candlestick patterns that you have there, you just have to draw a trend line, right? And then what are you waiting for? You're waiting to see when the price is approaching that resistance level, and then if you see those type of candlesticks and then you get a confirmation, of course you jump in and follow the downtrend. Remember, I'm insisting on this, that once you get that type of a candlestick, it just gives you a signal that it's just about the time that you're getting a rejection of the price or maybe a continuation of the trend. So wait for a confirmation to give you more or higher probability that you can ride the trend. Really important. Just more examples here, right? And with this one, I just want to highlight that along the support or resistance levels, in this case here we have, we can see both of them, right? Resistance at the top and support at the bottom. So you might have types of candlesticks there again that are not really pin bars, like you can see on the first. You can see on the first point here. You can check there and see we have a candlestick that is similar to a pin bar, though it's not a pin bar. That's an indecision candlestick, right? The next one again, you can see we have a candlestick here. It's an indecision candlestick. So here we have a lot of tight trading, right? But on the last resistance point, you can see we have a very nice pin bar there. So what I want to say is, once you see those type of candlesticks again along those levels, you might want to wait for a confirmation, right? The candlesticks forming along those levels, support and resistance, might not always be perfect pin bars. Although if you find a perfect pin bar, the best for you. If it's not a perfect pin bar, it's a candlestick that shows tight trading. You might want to wait for confirmation. For example, in that case here, once you have this candlestick here, all right, once you have that candlestick there, then of course the confirmation candlestick is the next one that formed there, right? And at the close of that candlestick, depending with whether you are a conservative trader or a reactive trader, right, or an aggressive trader, sorry, you might want to enter your trade there, or maybe wait for the confirmation, at least for 2 candlesticks to close below, and of course it will have cleared the gains that have been made by the big bullish candlestick there, and then you might have considered entering there, of course having your stop loss at the top, and depending with the risk reward ratio that you're following, then you target your profits down there. All right, again, when you check at the bottom here on the support level, you see that we have this type of a candlestick, right? It's not a perfect pin bar, but just about to give the structure of a pin bar. It's more of tight trading, but after that, of course, you see the second candlestick here confirmed. Yeah, but again, if you are a conservative trader, you would wait maybe for the second candlestick to close, and at the close of that candlestick there, again, depending with your entry, you might consider entering your trade there, then have your stop loss down there, and then of course, depending with your risk reward ratio, you know where to target the profit. And you can see this one went on pretty nicely. And that's just an example of how you can trade with support, resistance, of course, price action. Now, another very important price action setup that you can look for is for inside bars. It's basically a 2-bar price action trading strategy where one bar is smaller than the other, right? And the smaller bar has to be within the high and the low range of the previous bar, right? So the high is lower than the previous bar's high, okay? And the low is higher than the previous bar's low. Okay, that's if you have one candlestick forming, the first candlestick forming, and then you have the second one forming. So considering the one that has formed has been formed lately, it has to be within the highs and lows of the first one, and that's why it's an inside bar. So its relative position can be at the top, the middle, or even at the bottom, right? Doesn't matter. But the bar before the inside bar is often referred to as the Martha bar. Okay, as simple as that, Martha bar. So inside bars show a period of consolidation in a market. Consolidation is where you have indecision in the market. So it's like buyers or sellers trying to get in, consolidate those volumes before, of course, you can have the market taking the direction. So a daily chart inside bar will look like a triangle when you go to lower time frames on an hour or 30 minutes time frame. So sometimes when you check on a lower time frame and it's like you're seeing a triangle, then probably if you go and check on a higher time frame, like on a daily time frame, you might find that it's forming an inside bar, like a consolidation before the market can take or can pick on a direction. So they often form following a strong move in the market, then the price poses to consolidate before making its next move. However, they can also form at market turning points and act as reversal points or reversal levels along key support and resistance. So it's always good that you check the inside bars on 4-hour charts or even hourly time frames. That one would give you a better signal to get a very good entry. And this is just how they would look like. You might have one or two or several, right? The structure of the inside bar might be either a candlestick where we have tight trading. It can be a doji, like you're seeing in this case here, doji like this one, or it might be a pin bar like you can see in this case here. But so long as the highs of that inside bar and the lows are within the mother bar, then that's the inside bar we're talking about. Those are the setups that you might want to look at. Now, how do you trade with those inside bars? Of course, you would better look at it in trending markets or in the direction of the trend. Of course, they are typically referred to as inside bar price action breakout pattern. That is, if you're using them on trending markets. They can also be treated counter the trend, right? That's meaning that you checking on when the trend is changing. All right. So the classic entry for an inside bar is to place a buy stop or a sell stop. Remember the pending orders, right? And at the high or low of the mother bar, then when the price breaks out below the mother bar, then you can enter. You can have the order filled. Right? Remember, a pending order is an order that is executed in the future when that price is hit. All right. So it's always good to use the inside bar strategy with the pending orders. Right, that is the buy stop or sell stop. Now, stop loss, you check out for the appropriate level to put the stop loss on the opposite end of the mother bar, depending with the direction that you're having your order filled. So if the mother bar is long, then you can maybe check on whether you can have the stop loss at mid-range, that bar. And here you want to look at an example of how you can use those inside bars to write a trend or for a trend continuation. So these examples is just on how you can treat an inside bar pattern in line with a trending market. So in the two cases that you check here, the inside bar patterns would be called inside buy signals or inside sell signals. You can see on the first chart here, we had one candlestick with the highest level at that point. Of course, you can see at that point there, and we have several inside bars there. You can count them, maybe 1, 2, 3, 4. There are so many. And once the candlestick closes above, then of course that is the best point to have targeted your pending order. Just have your entry there. All right. And depending with your strategy on how you enter your stop losses, again, you can maybe target them at the nearest support level, either at the bottom of this candlestick here at the bottom, or maybe at the middle, depending on how you like managing your risk. And then of course, based on this distance here, right, this is your risk, the risk that you're taking in the market. Then of course you see how much you're going to target. Again, at another level here, you can see we have inside bars, and there you enter to take advantage of following the trend. This is on an uptrend, and on a downtrend, you check there, of course, along that trend line, right? You have one very big bullish candlestick, and all of a sudden you have an inside bar there. I hope you can note it. And then depending again with whether you are an aggressive or a conservative trader, or depending with your trading strategy, you can wait maybe for the second candlestick to close lower, and there could be your entry. Right? Remember, entry strategies into trades depends with you as a trader, right? We might be trading the same inside bars, but there's someone who is going to enter the trade earlier. There's someone who's going to enter the trade after several confirmation candlesticks as well, right? It depends. But once you find the inside bar, check on the best place where you can enter the trade, because you have the opportunity to ride the trend. Again, just inside bars, you can check out on that one. Yeah. So remember, the skills to note these inside bars, it comes over time. It's not a one-day affair. We're just highlighting the most important things that you need to check out. But then for you to master this skill, remember, it's an art. You need to take time, and over time, you will master the skill, right? Of course, you find so many fake outs, and you need to understand the right time and the right place to spot for those inside bars, and the right place to enter your stop loss and take profit, those type of things. and the best place to time. It's really very important. It's subject to practice for you to master that skill. Okay, this is what we're talking about on a reversal pattern, right? So remember, this price is just testing this support, and once you get an inside bar again at the bottom there, you can see it. After that, then of course you have an opportunity. Again, just to repeat, you can see that the best place to have entered this trade is after several candlesticks are formed, just to confirm for you. So make a choice whether you want to be an aggressive trader or a conservative trader, but both of them will give you an edge in the market. What matters is how much are you risking there, right? For the aggressive traders, you must have very tight risk management strategies, because remember, you're entering the trade early, right? You're entering the trade early, so you want to be very careful, because it's not yet confirmed, and you might be a victim of a big loss or a very fast loss in case it just doesn't go the right way. Again, for a conservative trader, you might have a little bit higher level of probability when you're entering your trade. So those are the two things that you need to consider. So whether you want to be aggressive or a conservative, well, there's none of those strategies which is better than the other. It depends with how you master your skill. Now, a very nice setup here again that you might want to consider in your price action trading is an engulfing candlestick. Can be either bullish engulfing or bearish engulfing. Okay, remember, in forex trading, you just want to understand when the price is trending upwards, when the price action is trending upwards, for you to get a spot to enter, or when the price is trending downwards, to get a spot to enter and ride that downward trend or upward trend. So we can have bullish engulfing candlestick or a bearish engulfing candlestick. For a bullish engulfing candlestick, then that one gives you a signal that you might be getting an opportunity to buy. Yeah, it's a two candle reversal pattern, right? And the second candle completely overshadows the real body of the first one. This is like an opposite of the inside bar, right? If you can see it on the chart there. And of course, the second candle completely overshadows the real body of the first one. It doesn't matter the length of the wicks. Okay, here we're talking about the body. So a bullish engulfing candlestick represents that the bulls have really got control of the market. Yeah, control of the market, and the bears don't have that same strength. Of course, bulls or buyers have got no bigger volumes in the market. All right, and the bulls have completely covered the red body. If you can check on that, now that one shows that the market is ready for an uptrend, or the buyers are getting the momentum. All right, so it's an opportunity for you to jump in, whether if again you are an aggressive trader or a conservative trader, you want to get the right entry there. But it's an indication that it's about the time you get an opportunity to ride an uptrend. Bearish engulfing, just the same case, a candlestick pattern where you have a small green candlestick or bullish, and then the other candlestick, that is the candlestick that forms next, is a large bearish candlestick, of course, showing that the bears are now getting the strength. Okay, the pattern shows that the sellers have overpowered the buyers and are willing to push the price down aggressively more than the buyers, and it might mark the beginning of a downside. Now let's look at examples on our charts. How do you trade the bullish and bearish engulfing candlesticks? Of course, you can have them as a trend continuation, and you always looking at this type of candlesticks along a support or resistance level. And this one is a support trend line. You're on an uptrend. Remember previously or maybe if you've had in our previous trainings, we always told you that trend is your friend, and the best thing you can do is get the best entry level. If it's an uptrend, to ride the uptrend. So here, using the engulfing candlesticks on this uptrend, let's check out on how you can look at them. So the power of the bullish and bearish engulfing candlestick patterns is in the trend following. All right, the trend has already formed. You can see a very nice uptrend like this one. So you want to jump into that trend, just have to wait patiently when the price is approaching that trend line, and then check out if you have an engulfing candlestick, right? And they're really very effective, and they form after the market makes a correction during a trend, and you get a signal to enter the continuation. Yeah, you can see what we have here. All right, the bearish candlestick there is really small, and the bullish candlestick forms with a very big range, right? A very strong bullish candlestick there, showing dominance of the buyers in the market, right? And that's a very nice signal for a trend continuation. And for a downtrend, just check out here along the trend line. Of course, we have a very big bearish candlestick just after smaller bullish candlesticks. That's a signal for you to enter the market. All right. And then, of course, remember, you're putting your stop loss some pips away, or pips away from the top of that engulfing candlestick if it's a downtrend like this one here. So the price action approaches the resistance area, and at the same time a bearish engulfing pattern appears around the zone. This is a possibility for you to, of course, check out for a strong bear movement. And of course, you want to jump in and take opportunity of that new trend. All right, very important there. Again, these are examples of those engulfing candlesticks. All right, you can see here we have a very big one. Although this type of candlesticks, again, they come sometimes out of events or maybe booking of profits. All right. So something else, even I see these big engulfing candlesticks. All right. Now this is where you need to be really careful with them, because you might get a very fast correction of that price movement. So this is where you have to be conservative. Whether you are a conservative trader or an aggressive trader, you need to be conservative. With this type of engulfing candlestick, that's a very big price movement that you want to consider. You really have to be careful about your stop loss level, right? And again, even your entry. At this point here, you check at the bottom. And one thing I would really put out there is that with this type of an engulfing candlestick, wait to get a confirmation. What's the confirmation here? Wait and see whether the price is still going to, as it's testing upwards, make sure it's going to break below that low, right? Because after such a big move, most of the times you might find that the candlesticks that follow are really small candlesticks because of the exhaustion of the momentum. But with time, it might be about to have another downtrend there. So again, it's an engulfing candlestick, but again, even the size, if the size is too big, again, you might want to reconsider your steps. Right. Thank you so much, ladies and gentlemen. And now it's time for questions. I can see several of them here. So someone is asking, what happens if a currency loses value completely? Well, Licky, it's very unlikely that a currency loses its value completely unless that country has collapsed completely. All right. So when we're talking about these changes in the value, actually remember when we're talking about calculating the PEEP, right? It's on the 4th decimal place. So that's what means that the value changes in these currencies, actually they are really, really small, only that they have to be magnified because of leverage. All right, but the change is, it's all about volumes. All right, it's all about volume. So when you're buying, you buy in terms of volumes. Remember, the smallest volume you're buying here is a micro lot. A micro lot is equal to 1,000 units. All right, and it's because of that trading with high volumes that really gives opportunity. So I'm mentioning that one because you cannot have a currency really being extremely undervalued to that level, right? So you can't have the currency losing quite a big value as we might imagine. But of course, that one again is representing the movement of the price, and you always see it. All right, Charles, let us know your challenges. Someone is asking, for inside bar, do you need to know the type of a candlestick inside, like bullish or bearish or type of, doesn't matter. So going back there, it's really important that we look at the type of candlestick forming. You're asking about the inside bar. The inside bar, you need to look at the type of candlestick, the type of candlestick which has formed after that. All right. If it is a bearish candlestick, if you're on an uptrend like that one, it's a bearish candlestick that is forming. Then of course it is very important. All right, it's very important, especially for a reversal. It's very important. It's a bearish candlestick. Okay. So yes, the type of candlestick really matters. Patrick, really unfortunate you've missed this one. There's no problem. Remember, we have different topics for different days, but again, Eric, make sure that you register for our webinars. We will take you through the price action again, especially in our A to Z classes, right? And if you're in Nakuru, again, you can register for our workshops. We do them, though with a little number of attendees, right? So even if you've missed out on this one, don't mind, Eric. You can always register for our webinars, and you can get more insights on using it. Thank you so much for that question. What's the best time to trade? Well, it depends the type of trader you are. Remember, we have different types of traders. We have scalpers, we have day traders, swing traders, right? Depending with the type of a trader that you are. And again, with it depends with your work or your lifestyle, right? If you are a scalper, then probably you might want to be trading on lower time frames, right? Because you want to take advantage of very small moves in the market. Okay, that's where you want to see those big moves, and you're taking advantage of fast movements and within a very short time, right? Those are things that you won't note on higher time frames like daily. Okay, if you are a day trader, of course, you see, you'll be leaving your trades to flow for quite some time, maybe hours, maybe even day, but not beyond 24 hours. So again, with that, you might see yourself trading around maybe 1 hour, 4 hours, or even daily and 15 minutes, right? So the time frame really depends with the type of trading that you want, right? But you can always use all the time frames to analyze the market, something of course called top-down analysis. You want to understand how is the, if for example it's some price action here that we are covering, you want to see the price action set up on a daily, moving down 1 to 4 hours, and then of course to 1 hour, and then you can settle on the time frame that you manage your trades, right? Good question there, Eve. So it depends with the type of a trader you are and your strategy again. The lowest amount, Mike, that you need to start trading, it depends with your target. All right. Maybe in the future we will have a class or a webinar to look at how you calculate the risk amount and how you start targeting. Remember, when we're looking at these charts, I want to give this example. Looking at this one, let's say, for example, you got this inside bar, and again, this one answers the other previous question of whether the inside bars have to be bullish or bearish. If you're looking for a trend continuation, the inside bar has to be bullish, of course. And now going back to your question, Mike, with how much, whether you require a lot of money or little money to start trading. You see, when you're trading, you're told not to risk more than 2% of your account. So let's say if you calculate your 2%, if you have like I don't have a good pen to calculate. If you have like 2% is 2 out of 100. Yeah, you do 2 out of 100, and maybe your trading account is worth let's say $1,000, right? Let's use 100 and 1,000, right? So it means that every time you're risking in the market, in every trade, you're risking only $2, all right? And the risk amount is what you are losing when your order hits the stop loss here, right? If you entered at this level here, if that was your entry, all right, and down here is where you have your stop loss, okay? So this distance here between the entry and the stop loss is your risk amount. So if you deposit a small amount of money like $100, then of course, if you are careful with your trading and you're managing your risk well by not putting your capital to a bigger risk amount of not more than 2%, then it means here you have $2 at the stop loss level. And what you're targeting, if it's a 1-to-1 risk reward ratio, then you're going to target $2. Right? If it's a 1 to 2, you're going to target $4. That one tells you that depending with the amount of money that you deposit in your account, then it defines how much you're going to risk, and then of course has a bearing or has an impact on how much you can target. Let's say, for example, you had $1,000. If this one was $1,000, right? You add another zero here for $1,000, then it means that 2% is $20. All right. So at this point here, this stop loss value is going to be $20. You have to adjust it to be $20 so that if you're targeting 1:1 again, all right, you're targeting 20, a reward of $20 when you're risking 20. If it's 1:2, you're targeting a double reward, so you're targeting $40 for 1:2 risk reward ratio. So the question of how much you need to deposit into your account again, looking into the theory of how much you're risking of your account, it's really a matter of how much do you want to make at the long run. Because if you're managing your account well, the risk amount per trade is what will guide you to what your target. And of course, even if it depends with the trend that you've got and the type of trade that you are in, but again, if you're going to be in the markets for long, you have to follow the risk management rules strictly, and the risk amount is really very important. So how much you want to deposit depends with how much you really want to get in the market. But again, if you're starting, you can start with a small amount and learn the ropes, and then of course you can keep on adding to your experience. Formation of 3 candlesticks suggesting price reversal. So when I was talking about 3 candlesticks, I was simply speaking about being an aggressive or a conservative trader, right? An aggressive or a conservative trader. And again, I will just try to repeat. For example, if you look at that setup there, right? Remember, this is an inside bar. We have an inside bar there on the charts. We have an inside bar here. But again, the previous candlestick, this bullish candlestick here, remember the first inside bar is not even covered, has not even, it's really not giving any confirmation, because after this inside bar, there's a likelihood of having another candlestick forming and breaking above that trend line. So as a conservative trader, that's what I say, that you might want to wait for another candlestick, at least like this second one, which formed and closed lower. All right. So it depends whether there are 3 candlesticks or 2 candlesticks. Then you might want to wait and check on them. All right. That's what I meant, Peter. I hope I've answered your question. Okay, another question here. Pips, it more like lots. Well, pips and lots are different. Lots are the units that you use to specify what you are trading, how much you're trading in the market. A lot specifies the size of the trade. Okay. And pip is the smallest movement in price. That's just the difference, Mary. You can attend just go to FXPesa.com and register for our A to Z classes to get more, and you have more time to speak about that. Good question there, Mary. We have so many questions, just want to scan through them very fast. Remember, we have 10 minutes remaining. Keep the questions coming. Of course, I'm excited to interact with you here and answer your questions, and make sure that you use the insights that we are giving here to even be a professional trader. Remember, in our trainings, we'll put you through so much material. We start from the price action. We give you information about using support and resistance, give you information about indicators, and we cover several indicators, all right, show you how you can use several indicators. But then, as a trader, you will want to select what really works for you, okay? Joseph, you have a recommendation here. You need to be replying to these webinars severally, right? We look into that. Thank you so much for taking your time to attend. So how do you know when it's optimum to close your trade? Of course, you look at your target. We say that when you're entering your trade, for example, when you're entering your trade, you need to have predefined entry and exit levels. The thing is, let's say, for example, you're looking at that chart there, and on the second engulfing candlestick that you have there, you have the signal to enter a trade, right? So based on that, then of course you ask yourself, now that you have a signal to enter a trade at the bottom there of that candlestick, then what are you targeting, right? What are you looking forward to get? And maybe even before that, what is the risk that you're entering in? That's where you're going to look at the lot sizes, the volume of your trade, and then of course you decide on the stop loss, where you're going to put your stop loss, where you're going to stop your losses in case it doesn't go well. And for example, looking at the charts there, if you have that engulfing candlestick, and then of course that's why you'll be entering your trade, then, and you're on a down trade, it's conventional knowledge that your stop losses should be somewhere above or near or at the trend line there, or above the trend line, so long as it's you have some distance between the high, the swing high. That's why you're going to have your stop loss, because of course you see you've entered your trade down here. That's why you entered your trade. And of course, based on the amount that you're risking in the market, right, there's something called risk reward. How much are you risking? So in this case, this is the amount which you're risking. If your trade doesn't go downwards as you were expecting at that entry level, because you're expecting that the trend is going to be downwards that way, if it doesn't follow that trend, yeah, following the signal you've got from the price action here, and it moves up here, then that will be your loss. So you first of all decide where will you be putting your stop loss level, and that's one there, and you decide how much are you risking, all right? So that based on how much you're risking, this is like X X number of pips, then how much are you targeting? Is it another X number of pips? Maybe, for example, from that level to another level down here, could be this distance is another like X number of pips. That is for 1:1 risk, 1:1 reward. And if you're going to target another like X move in the market, depending with how much you've put as a risk there, now you have 1:2 risk reward ratio. That's how you target where you're looking into closing your orders. I hope you've been answered. Good question there, by the way. Good question. And there's really so many questions here. Don't be in a hurry to leave because we're looking at all these questions. Someone's asking about, though he left, do you guys have a signals group? Okay, we have a Telegram channel, and that's where you have educational analysis. It's not signals per se, it's educational analysis. So if you're, for example, we've scanned the market and we see there is an optimum opportunity in maybe a certain pair, certain assets, we will analyze it and give you the likely scenarios, all right? So not all currency pairs, just a select few. So when it comes to using them, right, just make sure that it's something that you treat. Don't just follow up a signal just because you found it there. Make sure that you know how to trade it, all right? So because we give you two alternatives, the likely movements of the market. So those are not signals, but they are education analysis information. It's education analysis information to give you more insights on how you can get an opportunity and trade. So for a beginner, someone is asking here, I'm a beginner in the market. How much can you start with? I think I handled that. Just depends with how much you're targeting in the market because it is pegged with how much you're risking, right? Difference between premier account and the executive, if good question there. It's all about spreads, okay? So for the executive account, we have the normal spreads, right? This means they are not subsidized. It's the normal spreads that we have there, and they are really competitive, right? But if you don't want those normal spreads, maybe you are a scalper, you go to the premier account. On the premier account is there you have very low spreads, and on the Euro USD, for example, or the major currencies, especially the Euro USD, you might find as low as 0 spread, right? But again, there is a small commission charge on the premier account. Patrick, I hope I've explained the 1:2 risk reward ratio, how much money is supposed to have an account to change from that lot, right? The lot is really determined by the risk amount and the distance between the entry and stop loss, Patrick, right? So what you look at, just because I have to answer you, right? What you look at is how much are you risking? Is $2 that you're risking, and then you check on the stop loss amount, right? You divide the risk amount by the stop loss pips multiplied by the pip value of a standard lot of that currency pair that you're trading. Then of course you find an estimate of the lot size that you're supposed to use. Hey Kui, you couldn't hear anything? Maybe you have to work on the audio. Anytime you're joining the meetings or these webinars, just make sure you join with the audio or check the options to enable your audio to make sure you don't left out with anything. Peter is asking, should we use candlesticks for confirmation after analyzing the price action? Well, it depends. Okay, if yes, you should use it, because if you're a price action, you're trading price action, it means that you're not adding the technical indicators. All right, so you're using the price action to give you a signal, and again, you're using the same candlestick to give you a confirmation. All right, so if you're purely using the price action, you have to master how you can use the same candlesticks to give you the signal, and then again, the formation of the candlesticks to confirm for you. Remember, it's your freedom. You might want to be a price action trader, right? Or you might want to include the technical indicators. But this one is specifically for those people who want to utilize the strength of looking at the pure movement of charts. Evans, what happens when you let the broker do it for you? Well, nothing happens. You just in business. But now, unfortunately, at EGM Securities, we don't do it for you, Evans. We don't trade for our clients. That's why we're here to empower you with that knowledge to understand how it is. And even now that you've asked about that, maybe encourage you to learn the markets, right? You have to understand how these markets are. It's really very important for you so that even if someone was trading for you, at least you have that knowledge of what is happening. Okay, it's always important for you to understand. Good questions here. So when you talk about trend continuation, Robert, it's where you're having a setup that is confirming for you that that trend is not yet towards the end. It's still continuing, just like the word says, trend continuation. All right, this is what we're talking about in trend continuation. Let me just pull out that chart. We are on a trend this way. We are on a chart here, and at this point here, as the trend is proceeding, of course, you know, the price action or the market moves in cyclic manner. So at this point here, as the price goes up and down, right, when you have these inside bars forming this way, okay, it's a signal for price continuation, for price action trend continuation. If the price jumps up again, remember I told you that when you're trading these inside bars, the best way is to have a pending order, right, like a buy stop to take advantage of the market. So that is what I'm speaking about there. Okay, great questions here. I'm really excited to meet with you here, ladies and gentlemen. And it's been a very exciting time interacting with you. All right. So this is just one of so many webinars that we're going to have this year. Remember, we started by looking at various simple tools that you can use. And when you go to the FXPesa platform, you can take advantage of those tools there. All right. And then we talked about how you can control your losses and cut your losses last time. Remember, it's very important. Even if you have a very effective trading strategy, if you don't have a good way of controlling your losses, you would last long in the market. And now today we've looked at price action, how you can take advantage of purely price action trading and have a very strong trading journey as a trader. Again, even as we have highlighted those three types of setups, yeah, the pin bars, the inside bars, the engulfing candlesticks, for either for trend continuation or on trend reversals, you need to practice and understand the best points. And again, you're checking along the support and resistance levels for you to get the right entry point. So it's very important you practice for you to get that skill. Remember, it's all about taking time. It's an art. Take time to practice, and with time, you are going to get the grip of it. And maybe something that I'll have to repeat today. Again, it's a quote by George Soros that it's not all about getting it wrong or right. It's all about when you get it right, how much are you getting? Right? And when you get it wrong, how much are you losing? So that have more of profits than losses. Otherwise, the thing is everyone in the market makes losses and makes profits, but the ones who remain in the market for long are the ones who are making more profits than the losses. Ladies and gentlemen, it's been a whole 1 hour speaking about the price action It's been exciting speaking with you here, and we call it a session. See you next week when we have another session like this. Bye bye.